I took OpenAI and Anthropic to the investment committee in 22-23 and was rejected. I'm not speaking for the broader family, it's a big family, right? But this part said, we do not want to fund the potential end of humanity. That's not going to be our legacy.
What we call the post-2022 era, you can see a decoupling of TVPI and DPI, right? So you're seeing these funds in there, it's like, yeah, we have the total values X, but where are the distributions? So until we see those corrections, you will continue to see this strategic shift towards.
Welcome back to Billion Dollar Moves, your front row seat to the world of capital every single week. I'm Sarah Chen-Spellings, your capital confidant and guide, and today's episode is a special one. I'm taking you inside a conversation from the LP Summit I co-hosted with Arctic 15 over the summer in Finland. An honest, at times provocative dialogue on how portfolios must evolve as we look beyond 2025. Very timely. Joining me were two leaders I deeply respect. Chris Rynning, managing partner at AMYP Ventures, the Piëch Porsche family office, and a longtime China crypto and AI specialist with deep experience across continents. Anulika Malomo, global investor, has worked with some of the world's most notable families, including the Soros family, and now serves as a non-executive director at HarbourVest, one of the world's leading private equity firms. In this episode, you'll learn what future-proofing really means in an age of compounding shocks, how leading family offices are allocating today from liquidity to secondaries to continuation vehicles, and why resilience, hedging, and thematic depth will define the next generation of outperformers. This is a grounded real-world masterclass. Let's get into it. We talked about the climate crisis. We talked about the rise of AI and the threat of AI, and of course, bias is a part of that. We talked about the ongoing ecological crisis. We talked about the uncertainty, volatility, where family offices now are deciding to double down on what they're good on, come back to the core. But how do we now future-proof our portfolio as we move forward? So for those of us who are not familiar with the work that you do, Chris, tell us a little bit about you and how you invest, and Anulika as well.
Thank you. So yeah, I run AMYP Ventures, which is part of a Piëch Porsche family office. In my day work, I run a global team that invests mainly in funds. And we will come back to a little bit investment strategy as it shifts. But we use most of the funds as a co-investment vehicle directly into their portfolio. And very on topic, after following Jeremy, I'm also the chairman of Humanitech.ai, which is an AI company exclusively focused on AI harm reduction. I spend a lot of my time in AI these days. And as an introduction, I may say climate change. I think if you have capital, whether you're a family office or an investor now, and you don't invest in protecting the planet, you kind of are an asshole. And I'm going to stand by that. And if you don't take the red pill and wake up to the AI threat, you need to wake up. This is real, and I think it should influence every board and every institution.
Yeah, Anulika.
My name's Anulika. It's a pleasure to be here and having spent the day with you all. I've really appreciated hearing the different perspectives across the different panels. So I'm an investor by background. Actually, I'm an engineer by training and lawyer, and started my career in investment banking. So I was that Lehman banker, and then moved into private equity, working with the Soros family office. And following that, now I have a plural role where I sit on multiple boards of investment managers, the largest being HarbourVest Global Private Equity, and I also advise family offices on impact.
Yeah, love it. So the topic of today is future-proofing our portfolios as we look into the future. What does future-proofing mean to you? I mean, how does that, make you feel about how you're allocating, and how have you, shaped it? Chris, I know you've spent a lot of time thinking about China as well. I was surprised we didn't hear the DeepSeek as part of a conversation, and how that surprised us all in many ways.
Yep.
What does future-proofing mean to you?
Yeah, I lived 10 years in China and 2 years in Japan before that. So I spent quite a long time in Asia. And as a family, and a family office. In terms of future-proofing, it's a lot of hedging. Hedging from our legacy assets. Obviously, we're the controlling shareholders of Volkswagen, one of the biggest conglomerates in Europe. Where's the biggest threat? China. I mean, China is coming in the mobility, automotive, AI sector. A plug, I published a book on China and AI in 2017, 2018, so it feels like a lifetime ago now. But understanding the threat, having lived there, spent time there, have connections there, it's part of hedging. So the two things I would sort of coming out of having spent a long time in China myself is we're actually competing against ourselves as well. So we have a lot of legacy assets in Europe. Thinking EV and China will be a major threat to our legacy assets. We are going into EV sector, into sectors where we think maybe Volkswagen, Porsche, Lamborghini will not be as fast. So we are investing in companies that are effectively competing with us. And then another takeaway is we're taking a smaller percentage of our assets, which we only manage our own assets. We don't manage third-party assets, which is a blessing. We experiment in very early stage stuff. And as an example, we were very early into crypto, just experimenting, just learning. Was prepared to lose everything, didn't, because we were quite conservative when we went into crypto and stayed with Bitcoin and Ethereum through the whole period up until today. And now, as everyone can imagine, we're experimenting in very, very, very early stage AI.
How about you, Anulika? What does future-proofing mean to you?
So when I think about future-proofing, I mean, the main word that comes to me is resilience. So you want to build a portfolio that is able to withstand shocks. I mean, who has a crystal ball? Who would have foreseen 2020? But you're investing in, particularly if you're investing in private equity, right? You're taking a very long-term approach. You're thinking 13, 15, 17, 18 years, depending on investment cycles. And now we're also seeing significant innovation in the private investment space, be it continuation vehicles or CVs of CVs, a lot of innovation in the secondary market. So essentially you're seeing innovation already baking in future-proofing, in my opinion, because when you think about making an investment, the most important thing to you is being able to exit and at what value. So that's what that means to me. So across the different hats that I wear, I'm quite fortunate to be able to have a vantage view on global portfolios across buyout, venture growth, infrastructure, direct co-investment. And so that gives me a view, right? And then also in the work that I do in supporting family offices where there tends to be more of an impact angle, you're also able to overlay your return objectives with thinking about your impact objectives, which is very important. So when I think about future-proofing right now, you really would be looking at a portfolio that is super well diversified across the different asset classes I mentioned, thinking about geographies as well as be it currency risk. But also I think the funds that I see that are doing this well with respect to withstanding shocks and thinking about the resiliency of portfolios are funds that have taken thematic approach to investing. So they're thinking about sectoral trends, key themes. Maybe you have a fund that's thinking, okay, so we're looking at the West and there's aging demographics and we're thinking about health innovation. So how do we think about building a portfolio around that? We're thinking about food, water scarcity, supply chain resilience. How do we build a portfolio around that? And so that's some examples of that.
Yeah. So both of you touched upon sort of timelines, and there was a lot of talk about exits and liquidity, and the reality is it is a crunch right now. The IPO window is mostly shut. A lot of talk on secondaries being baked into strategy from day one, even if you're an early stage fund these days. How are you advising your families that you work with in terms of time horizons, designing for exits and building the right amount of liquidity in the portfolio?
I think we come to maybe some of the same conclusions a little differently because we're a family office, obviously. So one of the least important investment criteria for us is to find the exit and think about the exit because we have such long-term capital horizon, and also find it somehow difficult to combine impact and return at times, right? Because they don't necessarily always sit together. And also, I think where you speak about, maximum diversification, we think a little bit more on hedging on certain assets, but I think we arrive sort of at the same conclusions. For us, liquidity isn't the most important thing. Instead of diversifying, we actually maybe more specialize and we more focus, and we go in very deep and very long term with the sectors and the companies and the founders, and really try to support them over 10, 20, 30 years. So very long time periods. We do that most often not as a lead investor, as a co-investor, as I mentioned, with the funds, who has more firepower than us, and building a consortium around a theme or a sector or a company. And in that process, of course, liquidity becomes a factor, especially when it comes to secondaries. For example, giving founders some liquidity, having maybe tied all their fortune or their upside into stock. So we are very active in this secondary market, mainly again through secondary funds. One such example is G Squared, where we've been LPs in all their latest funds.
How about for you, Anulika? I guess you've got a different portfolios, different pots of capital here that you're advising. How has your approach changed in sort of thinking about liquidity for these portfolios?
Yeah, so I absolutely agree with you, Chris. I think when I look at the family office hat, liquidity is not a constraint, right? However, when you're thinking about, if you have a large allocation to primaries, you have significant unfunded commitments that you need to be able to meet. And if you've modeled out your portfolio, you've made assumptions around liquidity in any case. So you need to be able to have avenues for liquidity because you have unfunded commitments that will be called. And you also want to make sure that you still have sufficient capital to keep investing in new opportunities. So it's that nuance with respect to even family office investing. So I think when I then look at the more LP hat, where you have LPs that require those distributions back, we are seeing that there is a lot, you're thinking more strategically and smartly about how you're deploying capital. So seeing a significant uptick in secondaries and direct co-investments, just because you're able to mitigate the J-curve effect of some of that, you're also enhancing your return while mitigating blind pool risk, particularly when you look at secondaries. We're seeing a shift towards more allocation towards these sorts of strategies, because you're not thinking you have 13, 15, 17 years to basically maximize those returns. I mean, just give you some data points. So look at 2020 vintages onwards, what we call the post-2022 era. You can see a decoupling of TVPI and DPI, right? So you're seeing these funds, we look at it, and in there it's like, yeah, we have the total values X, but where are the distributions? Yeah. So until we see those corrections, you will continue to see this strategic shift towards investments that are perhaps lower cash flow cycles and, being able to put more money to work in secondaries where you are able to sort of catch up on vintages that you might have missed. Because right now, a lot of LPs are sitting tight, and rightly so.
Yeah. So for family offices that have that bandwidth that you have, where liquidity isn't the first priority, what is then your first priority? How are you, thinking about the maximum impact of your dollar?
Not having immediate or short-term or even mid-long-term liquidity concern doesn't mean you plan cash flow. So when I go to my investment committee to make a $2 or $20 million investment recommendation, we always plan for the next 2-3 rounds of drawdown or capital call. If you're investing in a Series A, we always allocate to obviously protect dilution in the next 3-4 rounds. I wouldn't say that there's a lack of cash flow planning, right? So that needs to come in at all times. But it's something that I think is more comfortable in a family office setting for sure than if you're a 10-year private equity or venture capital firm fund. Your planning has to be completely different.
Yeah, and so Krista here from Halton Ventures, so she's running her family office and thinking about systems level change. And I wonder for your family that has that capability of taking in risk, right? What big risks are you now taking because of this privilege, frankly, that not everybody has?
Yeah, so we are experimenting with a smaller part of our assets. Like I mentioned, we went in very early in crypto. And now I guess we're landing and expanding. That's our philosophy. We go in with smaller amounts, and if we see it works, either if it's a token level or it's a founder level, we can double, triple, quadruple down very quickly. So land and expand, I think, is very much big part of taking that risk, getting involved. And now, because of the overwhelming big opportunity now across horizontally, it's obviously AI. And therefore, because of the valuations, we're also seeing ourselves forced to go earlier and earlier in the investment cycle. So we would typically be more comfortable to be in B, Series C, D. Now we're even co-founding AI businesses at the founders level right out of the gate. So we're being pushed earlier and earlier at this moment, I feel.
Yeah, and Anulika, how about for you? Have you had, clients of yours change tact the way that Chris has?
Not quite.
They're just sitting tight and waiting for liquidity?
Well, I think predominantly sitting tight, waiting for liquidity, but also having in mind, because diversification is key, you don't want to miss key vintages. So having in mind strategies that enable you to play catch up.
And where do both of you think the biggest disconnect of capital and opportunity lies today? I mean, there's been a lot of talk about hype versus real substance. And I guess, Chris, you would have an interesting view given you've probably been through the funnel of different avenues before deciding to experiment. Love to hear both of your thoughts on this.
Yeah, I think the biggest blind spot is the red pill area that Jeremy talked about. I think it's undoubtedly AI is going to change everything. I mean, you missed a brilliant presentation by myself and the other hall earlier today about the AI dilemma. And I mentioned I'm the chairman of Humanitech AI. My co-founder is Asa Raskin, who is the architect behind The Social Dilemma, the Netflix documentary that essentially said humanity lost first contact with AI. We're now at second contact, and this is a Oppenheimer moment for humanity. I think society and humanity as we know it is at risk and potentially facing extinction. Just a quick stat there. 50% of all AI researchers, scientists now, think there's at least a 10% chance that humanity will go extinct because of AI. And would you get on a plane right now if 50% of aircraft engineers were saying there's a 10% chance that this plane is going to fall out of the sky? You wouldn't, right? You just wouldn't. So I think the biggest blind spot right now is the potential harm from AI. And I think it's a big mistake chasing the largest language models and the applications, because who knows which models will be the winners? The DeepSeek moment, right? Who knows who will be the winners in 6 months, not 6 years, forget 6 years, which applications it is. So I think the biggest blind spot right now is the middleware segment in AI and all the trust and safety valves that we need to put in at this Oppenheimer moment. And we as a family are spending a lot of time understanding that. And I'll just add to this. I took OpenAI and Anthropic to the investment committee in 22, 23 and was rejected. Terrible financial decision, but the family, I mean, I'm not speaking for the broader family, it's a big family, right? But this part said, we do not want to fund the potential end of humanity. That's not going to be our legacy. But we're going to invest into all the trust and safety valves that can prevent harm. So that's what we're doing.
Yeah. Anulika, where is the disconnect that you're seeing between opportunity and capital today?
So maybe I just want to start by saying, we're in a new world, right? So where we're seeing interest rates will be higher for longer. And that, coupled with central banks continuing to try to rein in inflation, just means we will continue to see a lot of volatility in the markets and a lot of uncertainty given geopolitical risks, multipolar fragmentation and the likes of it. So just to talk about, in particular, where I see disconnect and dislocation, I think in the renewable energy space, there will continue to be opportunity. But what we have seen is a lot of capital flowing into first-tier assets across maybe solar, wind, but less so into midstream enablers. But you're hearing the likes of Tesla, saying, look, we're looking at divesting out of lithium batteries. There needs to be, different sorts of technology storage for energy. And also perhaps grid digitization. So just thinking about the midstream enablers that will enable the renewable energy transition, those sorts of areas.
That actually brings me to a question which I love to pose to you, Chris. The family invested early in crypto, and yet we've heard from Anna Herlin from the Kone family, where their family is very, very big on ensuring that we address the ecological crisis, which will be our biggest market failure of our lifetime. And yet we know the side effects of some of those investments. How are you thinking about ensuring that as you're investing and experimenting with new things, the impact side of things, you're not also creating harm?
Yeah, no, I think my opening statement, if you have money or a family office or an institution or a boardroom today and you don't take into the health of the planet and you don't invest in sustainability, you kind of are an asshole. I mean, it really has to drive everything you do. Of course, there's inevitable to, if you invest in AI, there is harm. So we have taken a step back from that financial return allure and invest in anything that can provide impact and sustainability and also AI harm reduction. So I think it needs to really be more than words. It's just taking those painful decisions to not invest sometimes and to invest in the right teams and the right portfolio. And I think that there's a clear misallocation on every level, from nation to sovereign to institutions and families. And it's time to take the red pill.
Yeah. So for someone tuning in and building a portfolio allocation today in 2025, now knowing what we know, knowing that it's possible that China comes up with a DeepSeek that's half the price of what we've put a lot of capital into, how are you advising your families in building a portfolio, and which part of your portfolio should be focused globally, inwardly, and all of that?
We have a quite diversified base to start with as a family. So for us, it's more hedging on the higher value parts because we could very well get it wrong. And then it's experimenting in these very early technologies. And I think just a point on this, because I think I want to drive it home, is that when we whether look at climate change or no climate change or AI good or bad, we can't ask the question as if this is a cost-benefit financial return analysis, right? Because we can all see the good of AI. We can all see the harm of AI. But it's the wrong question to be asking. The reason for that is that the potential of getting it wrong in climate change or with AI is so big, even though the chance is relatively small, but it's so big that if we do get it wrong, it takes away the whole potential of enjoying the benefits. The benefits might not ever come if we get it wrong. And that thing needs to drive the allocation of your assets now, I think, more than ever.
So I haven't mentioned anything about AI yet, but want to make one point. I think we're seeing a number of PE houses that are building their own LLMs, utilizing internal memos and investment performance to be able to be smarter and faster with making investment decisions. I think we're going to continue to see a drive towards more of that, particularly in a world where, what I'm calling the new world, where we are seeing an increasing flight to quality. So you have to make fast decisions. Some of these secondary deals, co-investment deals are hitting your desk from your GPs today, and you need fast mover advantage. So I do see technology being able to help with making those decisions and enabling GPs, LPs to act faster. When you look at a lot of LP allocations currently, you're hearing a lot of, okay, so we're backing these GPs, this is a second, third time fund, they're top quartile, da, da, da. 5 years ago, you'd see a geographic graph where you'd see US 60%, Europe 20, 25%. You'd see rest of world. But now, 2023, 24, rest of world is going to zero. That's a big mistake. So if I were in a situation where I have to try to reallocate a portfolio today and I were to change my investment strategy, that should be a problem to any investor. Because the entire point of being a private equity, private capital investor is that you take a very long-term lens. And you're able to do so given all the additional innovative wrappers that I've mentioned, be it CVs, be it secondary, like you're able to be more patient is my point. Somebody on one of the panels mentioned India at a stage. So last year we saw 44% uptick in IPO values in India. India is a market that should not be ignored when you're looking at Asia. And I think what can happen, given lack of liquidity, but uncertainty, geopolitical risk, is LPs and investors begin to allocate in a way that really prejudices the future. And it's very important that you continue to take a long-term view. Private capital investing, PE investing, be it less so VC, shorter timelines, are very long-term games. You're looking at 13, 15, 17, 20 years.
Yeah, and I love that. And to bring us home here, I wonder, Chris, the kind of conversations that you're having with the next generation, the Porsche Piëch family, what is top of mind as we are now, thinking about the future? Are you optimistic with the kind of conversations that you're having?
We are technology optimists, right? The families are builders, entrepreneurs. We built companies and a fortune through building companies. So we can see that we're going to be more productive. We're going to have more predictive models. We're going to, a lot of the tech companies and our companies are more profitable than ever. So we see the benefits, right? But I think if the premise is that social media, this first contact that Jeremy was talking about, is that conversation dies, because we're all in this echo chamber of the algorithm is feeding you hate speech and outrage. If we're all in that endless echo chamber of confirmation bias, conversation dies and democracy loses, and therefore humanity is at risk. So we're very concerned at this moment. It's almost a little bizarre for us at sometimes to be sitting in a panel discussion and talking about portfolio allocation. I mean, what are you going to allocate if there isn't a society, if there isn't a planet? We are very concerned at this moment, and I think everyone has to wake up and start investing in not only sustainability, but in these safety measures that can get us on the right track.
Yeah. And Anulika, before you bring us home here, do we have time for one question from the audience? What are you categorically not investing in?
So many industries are going to be completely ravaged. I mean, next year, we're going to be back here thinking we didn't do more in 2025 to prepare for what is coming. So the world is going to be agentic. It's going to be run by agents. So I think a lot of money is going to be pulled out of asset managers, out of institutions. The investment criteria and strategies will change. And AI is going to drive that in every industry. People are going to lose their jobs. People are going to have to transition. It's going to get pretty wild.
On that note, Anulika, but also end us with some optimism of the future, if there is any left by the end of this.
I do think we need optimism. What are we not investing in? We're not investing in arms, anything that is categorically harmful for the planet. And I think that there is a bit of a dichotomy, right? There's this contention that exists where you can invest in crypto but have a renewable energy strategy, or you invest in EV and again so I think there's a lot to be figured out there, because again there are dynamics of capital, and also if you're an LP that has LPs and you're beholden to investors, then you just can't. I mean, you would, if you weren't, you would have maybe sat out of investing in China maybe 20 years ago. But, money continued to pile into places like China, irrespective of the regime. So I say that to say that there are dynamics of capital and we have to respect that. However, where you can do good, and that's why I love to speak with family offices, where you have more patience and you can think more thoughtfully about how you can be catalytic with your capital and your influence as to how you do better good. So I think that that's really where I see bright spots, and I want to say this is, there are people that are really interested in doing good. And I think that people do make the world go round. There will be no people without the planet. And at the same time, the planet will not be what it is if you didn't have the right people. I know that there are harmful effects, but there's also good. So I want to end on the note of saying that there are people that are super aligned with the interests of people and planet, and we should celebrate that, and there should be more collectivism, growing that space so that we act together and we build coalitions where we drive better impact for planet and people.
I agree with what you said. I think it's a good way to end. And I want to quote Charlie Munger, the late Charlie Munger here. He said very famously, show me the incentives and I will tell you the outcome. Yeah. So whatever it is, on institutions, family offices, boardrooms, just make sure there is a human and societal alignment in the incentives. Then we may have time to fix this situation. So think about the incentives when you invest.
Yeah, love that. What a great way to end. Round of applause, please, for our panel on future-proofing our portfolios, being optimistic about the new strategies that still exist and that is within us.
Phew, phew, phew. What a conversation, huh? Hearing these perspectives, especially along investors I deeply respect, like Chris, Anulika, reminded me how quickly the world is changing and why we all need to rethink how we build our portfolios. Here are my key takeaways. Number one, we're living through structural breaks, not normal cycles. That means the world isn't just going up and down like it used to. New forces like AI, geopolitics, and supply chain shocks are permanently reshaping the system. The rules are literally changing beneath us, and so should our assumptions in our models. Liquidity is your lifeline. Number two, we talked about why tools like secondaries and continuation vehicles aren't advanced strategies anymore. They're in fact essential for staying flexible when markets freeze or surprises hit. Number three, themes like climate and AI require sharper analysis. You can't just invest because it's hot. You must understand the real risks, the adoption curves, and the long game. That's how the best family offices build conviction. And finally, pacing. Pacing discipline truly matters. This means don't rush, don't spray and pray, and don't deploy capital just because you have it. The most successful allocators I know invest steadily, intentionally, and over time, not emotionally. If this episode helped you see the future of portfolios more clearly, share it with an investor who needs to hear this, and drop me a comment on YouTube or Spotify. I genuinely love hearing what resonated most for you, and frankly, it's a simple way for you to support this show. And once again, I'm Sarah Chen-Spellings, your capital confidant and guide, reminding you to stay intentional, move boldly, and keep building your version of billion-dollar moves. Until next time.